Let's touch base with our next guest, Aditya Narain, who's head research at Edelweiss Securities, joins us with his take on the markets. Aditya, good morning. It's good to have you after the big Diwali break. How are you approaching the new Samvat? What is it that you're telling clients? I do know that you've put out a range at 9,800 to 10,500 on the index. Explain that in lieu of the fact that we are staring at a bit of a political overhang for the markets over the course of the next 6 months into general elections as of May 2019.
Yeah, hi, morning, and a very happy Samvat 275 to you and your viewers. In terms of our market outlook, we really have two perspectives that are really driving our thought process. The first is that we do believe that, after the recent shenanigans that you've seen in the market, some of the froth in terms of the risk in the market has actually got pulled out. So there has been a kind of a risk reset that has effectively happened. And so to that extent, the market has leveled off a reasonable amount. And, that lends across both equity valuations, the FX market, and of course in a very meaningful manner as far as the fixed income market is concerned also. So that's what you have at one hand, which is, there has kind of been a risk reset down. The second bit is in terms of, in this process of this risk put down, has growth been impacted? Will there be a little bit of a challenge for the economy in the next 6 months? Quite clearly. Our sense there is that you actually are going to see some levels of impact as far as growth is concerned. In addition, I think, and most materially, I think risk appetite will come off a little bit, which is, the precursor or the basic requirement for growth going beyond. So I think if you really take both these into account, we actually believe that, the market is going to settle at its kind of a longer term averages, whether it is in terms of earnings growth, which should be 15-16%, or in terms of market valuations, which we think should really be 15 to 16 times, which is what it's been over a period of time. And as you mentioned, there is the overhang of the uncertainty of the elections. So I think given that context, we really think the market is going to trade between 15 and 16 times 1 year forward. And that's why we have this range, which is where we think the market will stay pegged. If it gets excited on any external developments, I think it's something you need to lighten up if you go materially over 10,500. Likewise, if externally it starts going down and anywhere below 9,800, that would be an opportunity to be much more aggressive with the markets.
Okay, that's the view coming in. Aditya, I just wanted to also understand which way or how really you're seeing the overall fund flow situation shaping up. While the domestic institutional investors really seem to have supported our markets to a great extent, the FIIs have either been on complete selling mode or have been on the fence. What is your sense that you're getting when it comes to the fund flows going into big events like the elections?
So I think this has been actually very interesting. If one thing has really withstood a fair amount of pressure, it's actually been domestic money flows. Because this is really the first time in the last couple of years that you've actually seen a material pullback at market levels. But interestingly, the SIP numbers stayed pretty robust. I think overall numbers have actually started inching up. So I think from a fund flow perspective, I think one part of it has clearly been a positive surprise, and I think that should hold in good stead, which is effectively the domestic side. If you were to look at the global side, there obviously has been a fair amount of selling that has actually happened, and I think they are still sitting at some level in terms of they're sitting on the fence. My sense is that I think from the global side, I would suspect it's going to be a little cautious for a period of time. I think India to some extent is getting a little bit more pegged with emerging markets than it has historically been. So I think that's where it will depend a little bit on, on an environment that is completely external. But I do believe with this amount of money having gone off, I think the first quarter of the next year could see, depending on where the market is and depending on where election expectations are, you could see some risk appetite build up there from the offshore side. But for the moment, I think the bulky selling has gone off. But I'd be surprised if you saw too much come in too much of a hurry. But if one takes a step back, if you marry the two of them, I think India is looking reasonably stable from a fund flow perspective, because you have that balance between the domestic and the offshore. And I think in this overall rundown, I think what domestic has shown is actually something that should provide a reasonable amount of comfort to the markets.
And how are you looking at the overall NBFC crisis? You've spoken about how it's hit the overall long-term growth cycle. It seems like risk appetite here also has weaned off, and the underlying fundamental problem still has not been addressed to a great extent, while there have been a lot of steps that have been taken in order to curtail or put a stop to what's going on in the NBFC space. What do investors do at this point in time after we have seen significant wealth erosion, or do you believe that things or the tide is likely to turn now?
Yes, so I split it up into two elements. One is what has been external, and the second is what is going to be internal. I think from an external bit, which is the pressure that the markets faced, I'd say that has probably rolled over now. I think in the initial days it was a little dicey and a little worrisome, but I'd say with money being pumped in, everyone being aware of the problem, I think the external issue has actually been settled. I think the growth risk that you face into going forward from here, particularly over the next 6 months, is that I think internally businesses are going to be actually much more watchful for the reason that they've suddenly experienced this, earth-shaking kind of event as far as their businesses are concerned. So I think that will tend to be more of the restraint on growth that you will see over the next 6 months, rather than necessarily the complete lack of availability of money. I think money has started coming into the sector. I think you will see more of it come through. But I just think businesses are going to view it more cautiously, and so it's going to be a safety-first approach, which will limit, how much they effectively try and grow, even if they can grow much faster. From a stock perspective, from an investment perspective, I think you will continue to see a little bit of a bounce, in line with what you've seen recently, because the big pressure points I think are over. Money is going to come in more slowly. But beyond that, I think there is going to be much more of a wait and watch, because what the market has to see is two things. One, how do companies finally react to this in terms of how they grow going forward? Secondly, they're going to watch a little bit for any, risk that might linger on or might come through over the next couple of quarters, at an individual stock level. And the third thing I think that will happen is there will be a revaluation to the extent of, do the NBFCs get the very high multiples that they were getting in between? And I think that's stock taking that the market will effectively also take. But bottom line, I think there should be a little bit more of a bounce given where how much they've come off. Most of their businesses are intact. It's just that growth has come off a little bit. So I think a little bit more of a bounce, but beyond that, there will be a stock taking in terms of how the markets look at them as a group.
Okay. Aditya, where would you be circumspect in this market? Especially given that we've seen this earnings quarter come and go.
Yeah, I'd say the areas that you need to watch for a little bit would be on the consumer discretionary side. I think it's been a little soft from what one gathers as far as the Diwali season is concerned. You've had headline volatility as far as markets are concerned, as far as the currency is concerned. So I think, that's a space that you need to be just a little fraction cautious of or watchful of. I think that's one place one needs to be clearly a little watchful. The other thing is, as an asset class, we'd probably remain more comfortable with the large caps than the mid caps, even though the mid caps have come off substantially. Because I think what has happened is that the market has paid a very large, or continues to some extent pay a very distinct premium for growth. And because growth could be under a little bit of watch going forward, I'd say there's going to be more comfort in the market with the larger caps, more normally growing businesses, rather than those where growth expectations are very high.
Okay, and Aditya, let's talk about those individual pockets. It's bottom up, you're positive on the pharma sector. Can you elaborate on that and give us a sense of what you're making of the consumption as well as IT sector?
Yeah, so from a pharma perspective, obviously there's been a certain amount of currency tailwind, but I think that's just a little bit of it. That's not really the story. I think what you actually started seeing, and some of it came through as far as the results season was concerned this time, is that I think the US market, after all its readjustments, is beginning to show a little bit of growth and a little bit of revival. And I think to some extent that is going to be the basis of this response that you see as far as stocks are concerned, which is, as a group, I think the pricing pressure that you'd seen on US pharma, I think, has tended to ease off. I'd say domestic, the quarter was obviously going to be a low kind of growth quarter given the GST impact and the base. But I'd say there also it's tended to be stable rather than materially swinging on either side. So bottom line, I think we do believe that there is a little bit of tailwind beginning to develop as far as the US cycle is concerned for these businesses, but it has to be much more bottom up and much more stock selective rather than a very broad brush as far as the sector is concerned. We have only a marginal kind of overweight in this space. The other bit that you talked about, which is the IT space, again, I think the IT space has got a little clouded with the fact that the currency has been tailwind. I think that's tailwind, and it's useful and it will bump up numbers in the near term. But I think there we tend to believe that there's a much sounder and a much more intrinsic and likely a much more longer lasting cycle that is at play. So we think the whole digital story is something that's going to run for a good 3 to 4 years. And given that you have so much business tailwind, given that you've had a lot of these businesses kind of restructure themselves and position themselves for this opportunity, and given the fact that IT or digital is a much larger and a much more material part of their income pies now, we actually think that's a much more structural story to play. It helps that in times of volatility it is also a defensive. But quite honestly, what we are trying to follow is the growth cycle that we see there, which we think is going to be an extended one, and that the better businesses are actually pretty well geared for it.
Okay, Aditya, thanks very much for joining us and giving us those details. Thanks very much for sharing your insights with our viewers.